October 19, 1987, the day we all got to know as Black Monday. That was one of the worst days to be trading the financial markets. But not for this guy. This guy managed to make one of his best trades in that week. His name is Paul Tudor Jones. Paul Tudor Jones is one of the most successful traders of the past century. His net worth is around 3.3 billion and he focused mainly on short-term trading. When someone can achieve such impressive success for himself, his clients and his firm, it pays to pay attention to the things he says. In this video, I'm going to go over some of the most useful trading rules he has been using to become successful. These rules have stood the test of time and I know it's going to improve your trading. Now before I jump into the first rule, please do me a small favor and hit that thumbs up button. If you are new to the channel, do subscribe as well because we come up with many new videos such as this to help you become a better trader. To encourage you to pay close attention, we also do a giveaway for our plug and trade trading package worth $37. So if you wish to participate in our giveaway, then look out for an emoji somewhere in this video. You can also find the full instructions in the comments down below as well. So let's jump into some of the most notable quotes from the man himself, Paul Tudor Jones. Number 1. Don't be a hero, don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good because the second you do, you are dead. One of the most important skills to learn as a trader is to leave your ego out of your work. As soon as you get the feeling you've got everything under control, you're going to screw up really soon. And that's simply because you can never be in full control when it comes to trading the forex market. The market does whatever it wants. The only control you have is your own actions. How you react to the changing market conditions is what is in your circle of influence. So focus on that. Number 2. Where you want to be is always in control. Never wishing, always trading and always first and foremost protecting your butt. Be sure to be in full control of your own actions. You are the only one responsible for your success or failure in the market. Define your trading rules and get disciplined to stick to them. Number 3. There is no training, classroom or otherwise that can prepare for trading the last third of a move, whether it's the end of a bull market or the end of a bear market. There are a lot of places where you can learn about the forex market. Our YouTube channel is of course one of them. But even with all the hard work we put in making the best forex trading tutorial videos possible, the best teacher is the market itself. There's a difference between experience and knowledge. No matter how good you've been preparing yourself to anticipate every move in the market, there will be many surprises that you didn't see coming. The only thing you can do is to be meticulous about your trades. Always have your trading plan ready, especially your exit strategy. When things don't go your way, just get out of your position. You have to know what's your worst case scenario at any one point in time. Number 4. The most important rule of trading is to play great defense, not offense. Most beginner traders are anxious to trade all the time. They have the common misconception that more trades equate to more money. So they keep looking for potential setups and enter them way too early, without having a real trading plan before going in on the trade. Beginner traders focus on their offense, while professional traders focus more of their attention on playing defense. They know there are and will always be a lot of great opportunities in the financial market. So there's no need to rush into a trade without having your trading plan ready. Instead, the first thing you need to control is your risk management and know your exit strategy for every trade. Never risk too much of your capital because you never know how the market will surprise you. Number 5, when I trade, I don't just use a price stop, I also use a time stop. If I think the market should break and it doesn't, I often get out even if I'm not losing any money. One of the key things for proper risk management is to use stop losses in your trading. The most common form of risk management is a stop loss. Orders that automatically triggers when price hits a certain level. Paul Tudor Jones recommends using a time stop as well. I've previously uploaded a video about how to incorporate time stop into your trading strategy. If you have not watched that video yet, do check that video out next. I will leave a link to that video at the top right corner and at the end screen of this video. Now, when you enter a trade, you anticipate a certain price movement. With a time stop, you set a specific time frame for this move to happen, and when it doesn't happen, you cut your position. Doesn't matter if you are taking a loss or are in a small profit. If the trade isn't acting the way you expected, then there's no reason to keep your money in it. Number 6, failure was a key element to my life's journey. Have you ever failed at anything? I bet you do, and probably a lot more in your lifetime as well. I certainly failed my way by trying all sorts of strategies. Now, the key thing with making mistakes is learning from them. By learning from your mistakes, you can improve yourself and grow as a trader. It doesn't pay to lose money and not take a lesson from it. Number 7, you always want to be with whatever the predominant trend is. Every great trader in our history have said something similar to this. There are many things that they debate about, but when it comes to this, a large majority of them are in agreement. When trading the forex market or any other instruments, you always want to follow the overall market trend. Simple mathematics shows that the odds are greatly in your favor when trading in the same direction as the predominant trend. Don't try to argue with the market trend when you are a trader. Just follow the trend, because when you argue with the market, you will always lose. Number 8, after a while, size means nothing. It gets back to whether you are making 100% rate of return on $10,000 or $100 million. It doesn't make any difference. For most of us, there will never be a time where we can really say if trading with 100 million is the same as trading with a smaller account. But the key takeaway from this quote from Paul Tudor Jones is that your trading strategy shouldn't be influenced by your account size. You should always have a clear strategy and follow your trading plan. Additionally, make sure that you are sticking to a fixed percentage risk per trade. Having the ability to size your position and manage your risk is actually an advantage. That's one of the great things about trading and why you can get started with a small account. You still need to learn how to properly handle your account and trades, even if you are trading a $500 account. Number 9, at the end of the day, your job is to buy what goes up and to sell what goes down. It doesn't get any harder than this. To be successful in trading, all you need to do is buy currency pairs that will go up and sell them at a higher price. And the same goes for the downside. Short currency pairs that are going lower and buy them back at a higher price. Don't make it more complicated for yourself than this. Understand that this is your main objective. Now all you need is to learn how to identify the pairs that are going to make a move, which I've already provided ample of strategies on this channel. Number 10, every day I assume every position I have is wrong. This is one of my personal favorite trading rules from Paul Tudor Jones. If you study psychology, you will know that humans are prone to biases. Most of us have something called a confirmation bias. It is a human habit to search for confirmation after making a decision. In trading, this means that when you are in a trade, you start looking for information to confirm your trade. Well, Paul Tudor Jones does the opposite of this. He assumes that everything at the moment is wrong, and starts looking for evidence that he really is wrong. Only when you can't convince yourself that you are really wrong with your position, then can you become confident that you have a good trade. Number 11, losers average losers. Never average down on a position. Don't buy more into a trade when the price has dropped after your initial buy. If you are in the red, you are wrong, at least for the moment, and there's no point throwing good money after bad. Yes, it might be cheaper at that moment, but it also means that your initial trading idea isn't working. Don't average down on a losing position. In fact, do the opposite. Average up on your positions that show you a profit. When your analysis is proven right, look for opportunities to scale in and maximize your profits. Number 12, you adapt, evolve, compete, or die. If you can't learn from your mistakes, then pursuing trading isn't for you. It is important to see your mistakes and adapt accordingly. Always be meticulous in your trading actions so that you will always know what led to you making a bad trade. When you know where it went wrong, you can adapt your approach the next time. By doing this day in and day out, you will eventually evolve into a profitable trader. Number 13, when I'm trading poorly, I keep reducing my position size. That way, I will be trading my smallest position when my trading is worse. Most traders feel the need to get back after a losing streak by taking bigger position sizes. One very useful trading rule from Paul Tudor Jones is the opposite. When you are in a losing streak, it means you are trading poorly. It could be because of your state of mind or that your strategy isn't ideal for that market condition. Either ways, you shouldn't want to risk more of your money, simply because the chances of losing money are higher at that time. So why choose to lose more of your account? Instead, Paul advises to do the opposite. When you can't seem to turn a profit, cut down the size of your positions. Risk less of your account until you get back in sync with the markets. When you are completely in sync with the markets and you are in a flow of strong trades, that is the time to start increasing your position sizes. Number 14, at the end of the day, the most important thing is how good are you at risk control. If you have a losing position that is making you uncomfortable, the solution is very simple. Get out, because you can always get back in. As covered earlier, risk management is one of the key areas to master as a beginner trader. When the trade is going your way, give the trade time to play itself out. Let it ride and hold on to your profits. On the other hand, when things are not going as you predicted, don't hesitate and exit out of your position as soon as possible. Don't worry that you've made a wrong decision by cutting your position when things doesn't look that good. You can always enter back when things look good again. And lastly, number 15. I look for opportunities with tremendously skilled reward to risk opportunities. There's no reason to take substantial amount of financial risk ever, because you should always be able to find something where you can scale the reward to risk relationship so greatly in your favor that you can take a variety of small investments with great reward to risk opportunities that should give you minimum drawdown, pain, and maximum upside opportunities. When it comes to risk management, position sizing is only one part of it. The other part comes from analyzing the risk to reward ratio for a trade. This has been something that I always mention on this channel. With every trade you make, you need to make sure that the odds of profiting from it outweighs the odds of losing money. The exact ratio is up to you to decide. Paul Tudor Jones uses a risk to reward ratio of 1:5, meaning that for every dollar he risks, he's looking to make $5 in profit. Personally, I find that 1:5 is a little difficult to achieve, but what's more important is that you understand the concept of seeking asymmetrical returns. And that's it for this video. I hope these 15 trading rules from Paul Tudor Jones will help sharpen your mind and your trading skills. Don't just watch this video, make sure to implement it into your trading. And hey, don't forget to subscribe, and I'll see you in the next video.